Big tech now trying to turn a corner after the worst month so far this year, but some analysts are now saying that's a buying opportunity. That's the focus of today's Tech Check with Deirdre Bosa. Morning, Dee.
So on a price-to-earnings basis, Megacap tech, it's arguably cheap again. Apple, Amazon, Google, NVIDIA, the rest of the Magnificent Seven, they have been hit by rising yields over the last month or so, along with the rest of the market, but their profit ratios have fallen harder. Now, if you exclude those 7 megacaps, the remaining S&Ps, 493 companies has seen its price-to-earnings ratio fall from 18 to 16. Now, if you look at the biggest names combined, they've seen that metric fall far more steeply, from 34 to 27 times. Goldman Sachs uses this chart to put all of that in historical perspective. The Megacap's PEG ratio has fallen below that orange line on the screen. It's median since 2013 and also the lowest versus the broader market since early 2020. A discount that Goldman says has only been reached 5 times over the last decade. Now, a main reason for that is fundamentals. Higher yields make future earnings worth less, but that should have more impact on high-growth, unprofitable tech. The megacaps are, right now, they're widely profitable companies, even if recession fears are overshadowing AI hopes. And here's another interesting dynamic. Over the past 3 months, Wall Street has revised up their earnings expectations. Analysts increased their outlooks for NVIDIA and Amazon's profits by 60 and 20%, respectively, just over the last 3 months. Meta, 14%, Apple and Microsoft, their earnings expectations have been revised down, but that may have more to do with visibility on newer products and technologies like generative AI and, of course, the Vision Pro from Apple. Now, the growth part of the megacap equation, it's not much to write home about, but it is stable and it does beat the broader market. 11% revenue growth expected in the current quarter for the Magnificent Seven versus 1% for the S&P as a whole. And all of this is to say, guys, that while tech isn't typically thought of as a defensive play, to play the markets, it may offer more protection than the usual hiding spots, as it did earlier this year, you might remember. In a longer-term, higher interest rate environment as well, those fundamentals, that could underpin big tech. We didn't even get into sort of the stable management, the wide moats, and of course that generative AI push that could bring growth rates up in the future.
I guess the flip side of the argument, Deirdre, and why they've been so pressured is high rates and what that does to the multiple, right, when it comes to higher-priced stocks. And that's always been a headwind for tech.
Exactly. And I think that you have to separate very profitable mega cap from the rest of tech, because what higher rates does, it makes those future profitability worth less. But mega caps, they're already extremely profitable. Plus, they have these huge cash hoards, right, which they're earning higher interest on. So I think that's why you can see them as more of a defensive play. But then you look at unprofitable tech or even less profitable tech with higher growth rates, and that may be less appealing in this kind of environment.